right now, as Sarah mentioned, we want to drill down a bit into the One Big Beautiful Bill Act, or whatever Republicans are calling it now, and into it has a lot in there for agriculture, both in terms of tax policy and then around the commodity programs as well, and the new rules, particularly around payments and some of the provisions in there. So, and I do want to encourage you to get your questions in. This is we have a short amount of time to drill down to a lot of really important stuff. So get your questions ready, so we can get those to Paul and Roger and Harrison. I'm going to introduce each one of them at a time. Let them talk about a couple of aspects of the bill and what may be going, or we may see going forward. First of all, just to my left, I want to start with Paul Neiffer, who's a thought leader on income and estate tax planning services. He's a past president of the Farm Financial Standards Council, a number of other positions. He is currently edits the Farm CPA report, a great blog, which I encourage you to check out. Paul, talk about before we get to some of the tax provisions, there are a number of changes made around commodity program rules. There's a lot of interest, obviously, in the reference prices and changes in crop insurance and commodity programs, but there are also some significant changes around payment rules and who could receive payments and how much they could get.
Yeah, so as you're saying, under the old rules, in order to get more than one payment for an entity, so a lot of farm operations now are structured as a partnership or an S-corp or an LLC taxed as a partnership, and there's multiple owners. Well, under the old rules, if you were what was called an entity, an LLC, or a corporation, even if you had more than one owner, you were limited to one payment limit. Now, for a lot of organizations, what that required them to do was to structure themselves as a general partnership. Now, each individual partner may end up being an LLC or an S corporation or a C corporation, but it made that organizational structure very unwieldy. It made it more complicated. It was more expensive because you typically had multiple extra tax returns you had to prepare and so on. So what OBA did, and I call it OBA, some people call it ABA, some call it OB3, sort of like Star Wars a little bit, but what it did is it now has there's a new type of structure called qualified pass-through entity. So if you are an LLC not taxed as a C corporation, any S corporation, any general partnership, any qualified joint venture, I'm going to use that term, and then any entity that's elected to be taxed as a partnership, which could include a corporation, you now are going to have payment limits based on the number of people that you have in that entity. So, for example, if you had 4 brothers, 4 siblings, 4 sisters, whatever it might be, that were farming previously as a general partnership, they were all subject to unlimited liability. In order to get around those payment limits, they had to structure it as a general partnership. Now they can easily convert over to an LLC. They'll still be taxed the same way, but they're going to have that limited liability protection, which is very important for our farmers out there to have that protection. So this is a very good provision. It's been introduced before, but finally we got it through Congress, so that was good.
Right, and what impact do you expect that to have on farm structure?
Well, I think certainly we're going to have a sort of a simplification of the farm structure. Matter of fact, last week I was reviewing a structure of a farm family, not a large farm family. They're farming maybe 4,000 acres, which these days is not a large farm operation. And in that operating structure for that farm entity, they had, if my memory is right, 7 different entities. This could eliminate 6 of those entities and bring it down to 1. So that is going to make it a whole lot more helpful. Again, even though I'm a CPA, eliminate some of those tax returns that really that don't serve any purpose. And then another provision that was in OBA that's very helpful is right now let's take ECAP or SDRP, Economic Commodity Assistance Program, or the Supplemental Disaster Relief Program. In order to qualify for an extra payment limit, not necessarily an extra payment, but an extra payment limit, your adjusted gross income had to be at least 75% of your total adjusted gross income. But the problem with that is the definition of gross farm income didn't include equipment gains in most situations. Well, starting next year, now again, not for the SDRP, but starting next year, equipment gains are automatically farm income, agritourism is automatically farm income, and then the direct marketing of farm commodities to a consumer like a farmer's market, that's all going to be automatically considered to be farm income. So those changes are very beneficial. It's been a struggle for us as CPAs and attorneys that help farmers sort of qualify for the extra payment limit. It's hard for us to tell a farmer, your only source of income is farming mostly, but technically we can't tell you that you're a farmer because your equipment gains didn't count. So that's all going to be very helpful.
Yeah, great. Continue on the tax, to drill down in some of the tax provisions. Roger McEowen is a professor of agricultural law and taxation at Washburn University. Also teaches at Kansas State, I believe, and widely heard. I believe you've got your own radio show.
Yeah, I have a national radio show. About 3 million people listen every day for 2 minutes, and some stations pick it up and carry 1 minute. And it's all over 300 radio stations plus Sirius XM 147. Yeah,
thanks again for joining us. Well, let's talk about the tax provisions in OBA.
Yeah,
we'll go with that pronunciation. We obviously know that it continued the expiring provisions from the Tax Cuts and Jobs Act from 2017, the tax rates, the estate tax, doubling of the estate tax exemption. We actually made that permanent. But there were also some changes actually made in some other provisions that really affect agriculture in terms of expensing and so forth. Walk us through those.
There are a lot of tax changes in it. This bill is almost 900 pages long, and the tax title is substantial, along with the commodity title that Paul was talking about. When you get into the business-related provisions, the big ones on depreciation is an increase in Section 179, a doubling of the 179 off-the-top depreciation allowance, and both the base amount and then the start of the phase-out, those increase. So we go from, we don't hit a phase-out until we're at $4 million of qualified purchases in a tax year now. And so that is designed to incentivize purchases, and of course bonus depreciation now is permanent at 100%, but there's a quirk in that one. 179 started January 1 of this year, the enhanced amount. Bonus starts basically from inauguration day forward with an election to still apply the 40%, and if you make the election to only take 40% bonus, then you're stuck with that. You've got that for the entire year. And Congress historically has stepped on the depreciation accelerator when they have deemed it to be necessary from an economic standpoint in the general economy. Farmers don't like to pay tax, and one of the things you have to watch and you have to be careful of, and I had a 2-hour tax seminar I was doing in the hotel room here this morning, and I tried to emphasize this point to the CPAs, about 400 of them that I had this morning, was we know our farm clients don't want to pay any tax, and they want to avoid self-employment tax. But with the enhanced depreciation provisions, what you're doing is you're front-loading this, and you're not eliminating it. So you're wiping out your basis on these assets, particularly if it's 100% bonus, and you might be able to do that with Section 179 also, depending on your level of purchases. And there are differences between the two, and those underlying differences stay the same from prior law. That they didn't change any of the underlying rules. But my point on that is, and for example, I'll give you an example here to illustrate this. You may change your behavior because you're being incentivized by the Congress, and then you want to do something different from a business standpoint. I had a CPA that contacted me while I was in Fargo earlier this week, and he was in Iowa, and he said, I inherited this client, and in 2020 he spent $800,000 to put up a hog facility. Now in 2025 he wants to sell the hog facility. He bonused that facility at 100%. He has zero basis in it. And so his question was, I think I've got a recapture problem, but is it real property under 1250, or is it the 1245 rule? Well, there's a special rule in the code that's going to recharacterize that to 1245, and so now all of that 800,000 becomes ordinary income, taxed at ordinary income rates. So that's a problem when you get really aggressive on these policies when the Congress changes the rules. It's great to have, but they've got to make sure they're talking with their tax practitioner to figure out what the best strategy for them is.
So you maybe big benefit on the front end, the tax benefit on the front end, and you're stuck with potentially a big capital gains on the other.
Yeah, he said, he sent me an email back, any workarounds on this? I said, well, you could tell him to die, and that eliminates the recapture problem. Yeah.
That's always our tax advice.
Yeah. Die.
Stepped-up basis
Step-up
fixes
basis.
everything. Yeah, okay. What's the practical impact of this going to be and what is it? Are you starting to see an impact on purchasing decisions?
Well,
what do you?
I have one piece of anecdotal, I don't know if it's evidence, but it's just a little story. We also have a home in Iowa, and I was up there weekend before, I lose track of time, was it last, I don't know. I was up there recently. I even forgot where I was at this morning when I woke up and what day it was. But our home there is about about a mile from the John Deere plant in Ankeny, Iowa. And I noticed when we were taking one of our grandchildren to school, we have to go past the John Deere plant, and there were lots of tractor trailers loaded with spray rigs and balers, one after another going out. And I told my wife, let's stop. I want to ask one of these truckers. And he said, these are deliveries of new machines and filling orders. So I don't know if that's spurred by 179 bonus. It doesn't hurt. And I do think earlier this year, when you looked at the economic data in the general economy, I think businesses were already front-loading purchases in the first quarter of this year, not only to beat anticipated tariffs, but also anticipating that Congress was going to restore 100% bonus. So I think they were factoring that into their decisions.
Yeah, and I think you have to understand that farmers are the only industry that are allowed to deduct 100% of every single asset they buy other than farmland. They build a new building,
right.
100% deduction the first year. So they're the only industry out there that every single real estate purchase other than the land is 100% deductible. So that is a big incentive for them to start making some investments.
Harrison Pittman, I want to move to you. I want to come back, Roger, too. You have some real estate provision to talk about as well, correct? But Harrison, I want to move to you. Talk a little bit about possibility of another payment coming down the line. Harrison Pittman is director, for you all that don't know, and I imagine there's not many, is director of the National Agricultural Law Center over at Arkansas. Has and held that position since 2007. Is that
more or less?
more or less?
Academic politics, I don't know where it starts or finishes, but somewhere in there.
Okay. Harrison, the Secretary Rollins just talked this morning a little bit about they're still very actively working on some kind of new payment plan. She announced that there's released another $2 billion from ECAP, the Emergency Commodity Assistance Program that was funded in December. So we got more money, some kind of bridge program coming. What do you?
So I'll start kind of with Secretary Rollins' comment today. She stated needs. Oh, how about that? Thank you. I'll start over. You mentioned Secretary Rollins. Her comment today was, I'm pretty close to word for word, but that Congress is going to need to act to replenish the CCC. I think I'm adding in the CCC part, but that's understood. That's the same thing that she said last week at the NASDA meeting in Rogers, Arkansas. And going back to January and February, of course, the election occurred, new administration come in. This question of, if we have tariffs, now that part of the equation's been solved. We do have them, and if we have retaliatory tariffs, and now we have them, And then if we have negative impacts from that, and now we're seeing potentially some of those, and if there's going to be something equivalent to what we had in 2018, of MFP 1 and 2 or something like that, now we're calling it a bridge payment. You know, back then I would, in the audiences I was in, I would say, or ask, like, where does the money come from? You know, in 2018, we had still some borrowing authority left in the CCC. And so we have to look at, you know, we had just come out of the experience at the end of the calendar year where, you know, a lot of the ag groups wanted $30 billion in assistance. And the deal almost fell through, and ag groups buckled up and kind of shouldered through and got the $10 billion. So I was kind of putting a picture out there like getting to this money is not going to be so easy. And figuring out where it comes from is going to be problematic, you know, and I think most people here are pretty familiar that the federal fiscal year ends in September 30th. That's why we're talking about shutdown again. Then in October of this year, we'll make farm program payments out of the CCC for this past crop year, and that's why there's so much talk about the OBA. I want to borrow the way you say it. You guys wouldn't like the way I say it, so OBA sounds great, but that won't apply until the upcoming crop year. And normally, Congress is going to come back in and fill up the CCC in the appropriations process. And right now, you know, that's where these technical, we say clean CR, you get into terminology like anomalies, which are basically a fancy term for modification on the CR. And so if we're going to have a shutdown, the question becomes how you open, but ultimately, where does this money come from? I've thought for several months that ultimately we would just stumble into Section 32 funding, when you see tariff revenue mentioned. And then while Senator Marshall was talking, I got notice that today President Trump announced that he wants to create a bridge payment out of the Section 32 funding. And I won't keep talking, I'll wrap up right here. I think there could be an open question as to whether the statute immediately allows that to occur without further congressional action. And so wait to see there. But one thing we do know is that we've had the Court of International Trade and we've had the Federal Circuit Court of Appeals recently rule, each court, the second one was of course on appeal from the lower, they've each ruled that was unlawful. The tariffs that are being implemented on the International Emergency Economic Powers Act. And the Trump administration asked the Supreme Court to take that up. They very recently said they would, and they're going to have hearings in November, which is lightning speed for the Supreme Court. That's going to be a wrinkle in all of this capacity to use Section 32, if only it's a delay in being able to access those funds. So we can put a pin in that, and I'll kind of quit talking there. And if you have any follow-ups, I'm happy to jump in.
Well, good point, Harrison. Let's pick up on that. So they do want to go forward to Section 32. Could you briefly explain Section 32? And then I want to ask you about again, a little more about the implications of the Supreme Court case.
So, like so many things that we in agriculture benefit from and just sort of blends in with the wallpaper of our policy infrastructure, it goes back into the Great Depression era. And Section 32 is basically tariff income. Like we know, we do collect tariffs even before what we've been going through. And Congress has set out some formulas, some percentage formulas on how that money gets divvied out. And so agriculture, I don't have that memorized right now, but I think there's 30%. Some of it's used for surplus purchases and some of it's dedicated to things like specialty crops. It's not usually a huge pot of money, in the big scheme of things. That pot of money is currently growing. We'll see, the implications of the Supreme Court decision could sort of like in the snap of a finger, stroke of a pen, kind of revert that back in another direction. But that's what that is. And so the tariff revenue that was collected in the first Trump administration, of course, through the Biden administration, and then the increases of what's occurred in the last several months, most of that's landing in that Section 32.
So because of the Supreme Court case, is it possible that the Supreme Court could rule that the administration acted that these tariffs were illegal, and therefore the money has to be refunded? And if so, what happens then? Is that even in the realm of possibility?
The answer is yes, but in context, that's one of numerous possibilities. So that is a possibility, and that's been acknowledged even, I think, in some of the statements from the Trump administration. In fact, it's part of their argument about why they should be allowed to do it, is that the practical consequences of even having to do that, specifically refunding some of those. But, you know, it's hard to say. You know, you have two lower courts that have looked at it, the Court of International Trade Court, I always say that backwards, but same thing, and then the Federal Circuit. At the Federal Circuit, instead of having a three-judge panel, which is more common, but given the gravity and the magnitude, there was they ended up having all the justices hear that. And it was not a unanimous decision. It was 7-4, right. And at least one, it's possibly two of those justices were appointees during the Obama administration. And so there's a lot of ways the Supreme Court can play this one out, and I wouldn't overlook the ability of them to send it back down on a procedural issue and kind of tilt their hand one way or the other, how they might rule substantively should it come back up, because that, depending on how they want to play that, we could talk all day on like the International Economic Emergency Powers Act and the majority, the concurring, the dissent. It's a 140-something page decision. But all of these issues that we're working through, whether it be like the foreign aid or federal funding, these are, in my view, they're kind of like sixth grade civics in a way, basic separation of powers, but they're kind of dressed up in these specific legal issues. It's ultimately a separation of powers issue for the court to decide, does the executive branch in this administration and potentially all future administrations have the authority to declare an emergency over whether it's fentanyl or immigration, or a future president could say climate change or health care or some other thing, and go down this path. So these will have an impact more broad than just what we're dealing with right now. It'll be a long-term change potentially.
Paul, do you want to add something?
Yeah, I think the other thing that farmers need to understand too, and perhaps the next panel will address it a little bit more detail, is right now the American farmer has a very good put, I'm going to call it a put option under ARC and PLC for this crop that's being harvested right now, or some of it's already been harvested. What do I mean by that? Well, under the effective reference price changes that were brought about because of OBA, we now have for wheat a $6.35 price as far as the reference price.
Where the payment kicks in.
When the payment kicks in at $6.35, USDA is projecting that the average price is going to be $5. So the American wheat farmer is looking at a $1.35 payment based on their yield. Now again, that's discounted by 15%. So the wheat's $1.35, corn's about 50-some cents, soybeans is 71 cents, rice is a $300 acre payment. So we know that pricing is down, but the farther that pricing goes down, the more that ARC or PLC payment will go up to offset that decrease. Now again, that's on an average, not for every specific farmer out there. So I think that's the one thing that they don't maybe realize, that next October, and perhaps Congress will accelerate some of that payment. We're looking at probably a $14 to $17 billion payment under ARC or PLC. And luckily, Congress also in OBA said, hey, American farmer, we know that you signed up back in March or February for ARC, and likely PLC is going to pay more, or you signed up for PLC and likely ARC is going to pay more. We're automatically going to pay you the higher of the two. So the farmer doesn't have to fret, oh, I signed up for ARC and that's the wrong option, at least for the 25 crops. So I think there's definitely more money in, plus as Harrison's talking about, some type of bridge or MFP number 4, 5, 6, whatever it might be. So there's plenty of money coming into the American farmer between now and the end of next year.
Right. Those payments, you talk about $15 billion or whatever it winds up being, those will go out a year from now.
Right now, they're scheduled to start going out October 1st of next year. We know that the Senate proposal last year, when they were talking about the Farm Bill, would allow farmers to elect to collect 50% of that, I think around April 1st. That didn't happen, but certainly legislation that may come down the road, perhaps they might allow that as just some additional certainty, especially for those bankers that are having that lending decision with their bankers.
Roger, I promised to come back. You actually were involved, I believe, a bit in a provision involving farm real estate that got very little attention, but talk about in OBA.
Yeah, this is
Correct.
new
Let's
section
talk about that.
1062 of the Internal Revenue Code. It was Senator McConnell's office out of Kentucky that contacted me with a concept, and the concept was the senator wanted farmers to be able to sell farmland to other farmers and not have to pay capital gains tax on it, as long as it stayed in farming for 10 years after the sale. And I told the young gal that called me, one of his tax staffers, that I'm not going to have to reinvent the wheel on this when we have 2032A, the special use valuation provisions in the code, that conceptually is the same. I can model that language. So I spent about a day and a half drafting it, sent it in, didn't hear anything. It gets to be late June, and so I called them back. I said, where is this at? And they said, well, it got scored. We had to change it. And it came out not very close the way I originally drafted it, to say the least. But what it does, they did retain a couple of the definitional rules, one of them from 2032A, over in determining what is a qualified farmer, what is qualified real estate, those types of things. The real estate provision was a 2032A provision. But what it allows a farmer to do is sell farmland to another farmer, has to be used in farming for 10 years, and you don't eliminate the capital gain, but what you're doing is you're taking the net tax liability on the sale, which involves a computation of their other income and the income from this sale. It's a complicated computation, and you're able to, by election, spread that out equally over 4 years. Now, some would say, and I ask this group to, I ask the groups I speak to, what's the difference between that and an installment sale? And they pick up on it pretty quickly, the CPAs do. Oh, it's a cash flow issue. That's right, because what you're doing is you sell the land, you get all the money up front. You don't do that in an installment sale. You get it in pieces. Here you get all the money up front, and then you're spreading the net tax liability out equally over 4 years. So it's a cash flow issue. Now, the one thing that I think will probably dampen the interest in this is that on the deed to the real estate, there has to be a restrictive covenant that restricts the buyer from farming that for 10 years. And I would think some buyers and sellers are going to be reluctant to do that type of a transaction. I've drafted model language. It's on my Substack. And I've had 2 different state real estate bar association real estate sections contact me about whether they could use that. I said, sure, I mean, comment on it and let's improve it. Let's get some boilerplate stuff going here. But that's going to be, I think, a restriction to that.
Yeah, because it's going to be restricted to a farmer. It can't be a cash rent landlord.
Right.
It can't even be a crop share landlord because it has to be under the definition
Right. Qualified farmer.
of a qualified farmer under USDA.
Yeah, now the interesting thing they did on that, Paul, is the qualified, what's qualified real estate is defined under 2032A. What's a qualified farmer? They went back to the 85 Farm Bill and said you have to be actively engaged in farming. And so that's the right-hand, left-hand test. So different tests for that.
And they say it's a 4-year. I view it more as a 3-year because the first payment's due April 15th.
First year.
With your tax returns.
Yeah.
So, yeah.
That's new code section 1062. The other one that's out there is new code section 139L of the Internal Revenue Code. And that one's for bankers, the non-farm credit association, kind of the FDIC insured banks. That's basically in some insurance companies too, and Farmer Mac. What that allows them to do is if they make a loan to a farmer that produces at least one ag commodity on the property, and that can be livestock and it can be aquaculture, it could be crops, then the banker can exclude 25% of the interest income they receive on that loan. But to get that tax benefit, so you don't double dip, if you generated expenses in generating that loan, producing that loan for the farmer, then you cannot deduct 25% of your otherwise deductible business expenses associated with that. Now, I asked a bank, I had a banker comment on the tax seminar I was doing this morning online, and I asked the question, will this incentivize you to drop the interest rate to farmers? And his response was, well, we've done the calculation and we think it will be able to drop the interest rate by about 25 basis points. And he said, that's not enough for us to reduce the interest rate to farmers. But the point of what Congress was doing here is to try to inject capital into the rural areas, not necessarily lower the rate. You got to watch what the Fed does with respect to that.
Okay. We have a question here, I believe, is about the, this is not really OBA. This is something that predates that.
And Roger and I are shocked that we got that
We
question.
knew this was
Yeah,
going to
yeah,
be
we're
the
not
one question
shocked,
coming up.
This is a question about the soil nutrient deduction. First of all, I would like one of you to explain it. And then, is it?
We don't have enough time
address
for
the
that,
question
Bill,
of whether
but,
this
uh,
is
Here's the
out-
concept. Here's the concept. Farmer buys farmland or you inherit farmland. But let's take the purchase of a farmland. So what you want to do from a tax standpoint to be most tax efficient, drop down the effective out-of-pocket cost of that, is you want to allocate value, the purchase price, to the extent you can, to items that will give you a tax deduction. So I'm going to allocate some of that to buildings, depreciable farm buildings that are on there, fences, if we're in the upper Midwest, tile lines, field tile lines, those types of things.
wells, irrigation.
Yeah,
pipe,
sure.
yeah.
And so the concept here is when I buy the farmland, there's stuff in the soil that has value that is diminishing over time, the nutrients. And so IRS said over 30 years ago that yes, you can do that. That's conceptually correct, and they gave us some bare bones outlines how to do it. They've remained silent for 30 years. We have nothing on this except what they stated most recently in 1995 in their Farm Audit Technique Guide. With the run-up in land values, this now has become important. So if you're seeing $20,000 an acre, $25,000 an acre, Paul and I did Lancaster County, Pennsylvania last month, and we had a CPA tell us that he had a client that bought land in the $35,000 to $40,000 an acre range. So you're looking for anything you can to allocate value to. So this gets big. And we
So
just
you
don't have any,
depreciate the value of the soil fertility,
the nutrients in the
Nutrients-
soil that
nutrients in
are,
the
it's
soil.
depletion. It's not really depreciation, it's depletion.
depletion.
IRS used three terms: exhaustion, depletion, and amortization.
Right.
So nobody really knows for sure exactly what it is, but it's a deduction.
Yeah.
So.
And so that's what it is. And it's like depleting an oil deposit, oil and gas deposit.
Gravel
It's
deposit.
like farming above the Ogallala Aquifer in western Kansas or in Nebraska or in the panhandles of Texas and Oklahoma. You can get a depletion deduction for the drawdown in the aquifer. Okay, so it's a depleting natural resource, so the concept is there, but we have no code provision. I know it's referred to as Section 180 in the code. That's not right.
Yeah.
It's not Section 180. That's for purchased fertilizer, but if it's depletion, we don't have a form. We don't have a statute.
But we have a deduction.
We've got a deduction. We don't know where to put it.
Yeah.
And we
Yeah.
don't know really what the guidelines are. In fact, Paul and I caught Senator Marshall's ear before he took the stage, and he had no idea what we were talking
And Roger and I had a call with the IRS on this
Right.
deduction a few months ago. It turns out we're in the wrong section, so we're still trying to maybe help them understand this deduction, because they actually referred to the 180 deduction, which is wrong. So
So what do you tell farmers at this point?
they're doing it. There's thousands of them doing it. There's probably been this deduction on 2 or 3 million acres over the last 5 years, and they're going to continue to do it.
And we're aware of some audits, but we're not aware of any changes that have been made as a result of the
Yeah.
audits.
Most of the audits, other than some procedural issues, have been all in favor of the deduction.
Is there
So
any implications for your basis?
it reduces the basis. And again, remember, Phil, what did I tell you to do to fix that? Die. So, yeah, yeah. So when you sell the land, you will have recapture at that point in time based on the deduction you took.
Right. But that's the number one issue in the ag tax world. It's really the wild, wild west right now.
Yeah.
So the question now is, if you're taking this deduction, you're hoping that the IRS doesn't change its
Yeah, that's the
mind.
fear. We had thought that there'd be a private letter ruling out by this time of the year, but the parties that were considering submitting a private letter ruling request pulled the request. And so we don't have any guidance, and I would like to write a statute and have something in the code. And the idea here is maybe we could use percentage depletion like we do for oil and gas and just statutorily fix a percentage to it and then move from there.
Yeah. So we'll see. We'll see.
But if you statutorily fix it, then there's potentially a cost to it.
Well, there's a cost to the companies that are pushing this.
Yeah,
Yeah.
They'll lobby against it.
yeah.
Harrison, I don't know if you want to get in on the, so,
They got this.
I thought that would be the case. One other thing we didn't talk about, we're running low on time, but one of the provisions we talk about in the, getting back to OBA is, in terms of the commodity programs, is this base update, 30 million, or I call it, shouldn't be called an update, it's adding
Increase.
30 million acres of base. How quickly do you expect to see FSA come out with something? They still have some decisions to make, don't they, with regard to what's non-covered crops that can be 15% that can be, you could get base on?
I was waiting for one of y'all to talk. Yeah, they still have some work to do on that. I don't know a specific timeline that they're on with it, but the
Yeah.
30 million is and they're opening it up to across the country, and then once it hits 30 million, it doesn't go away. They start to prorate it out.
Yeah.
But filling in the elements underneath that, I
Yeah,
think is
and just for
what's left.
people to understand what base acres are, there's about 242 million base acres right now on the approximately 22 covered crops under Title I. Corn obviously is the largest at about 100 million base acres right now. We haven't planted 100 million acres of corn ever. Soybeans, the base acres are about 20 million less than what we plant. Wheat's about 30 million acres more than what we plant. So the importance of base acres is that's how a farmer gets paid under ARC or in PLC. So if that farm doesn't have base acres, they're not going to get that payment. So what this is designed to do is increase that base acres from 242 million up to 272 million acres. So starting in the 26 crop year, which is when this is effective, so in October of 27, most farmers automatically under ARC and PLC will get an extra 12 to 13% extra payment just because their base acres are going to go up by that amount. Now, again, that's on average, because some farmers, their base acres are almost equal to their crop acres. Many other farmers might have 300 crop acres and 10 base acres. So it's just going to be interesting how they do that.
Yeah, and then we have an issue, of course, in the tax court just recently on whether you can amortize base acres. And we've had 2 cases now. Of course, they didn't
They
actually
punted.
decide that issue. They just said that the practitioner in Arkansas screwed up and didn't file a 3115 because they went from not claiming any deduction for base acres to claiming a deduction for base acres, and they didn't ask IRS permission. You can't do that. You have to file a 3115. It's a change in method of accounting.
Yeah.
Then a second case dropped last week. Actually, it was settled. So we got the ruling, and I don't know the rationale because the tax court only published 1-page opinion, but it just said you lose $369,000 deduction here, you lose another $70,000 deduction for this tax year. So obviously that taxpayer also did not file the 3115 to change method of accounting. But we're kind of back to that soil fertility issue. It's the same concept. Can I get a deduction attributable to, an amortizable deduction attributable to base acres? And I think you can. There's some authority for it. It's probably a general intangible is what it is.
A quick, we're about to run, we're running out of time. Someone wants to know if you all foresee any changes in the conservation easement tax credit.
Well, there was a big change about 3 years ago where these syndicated conservation easements they create a partnership, you invest $1 million and you get a $5 or $10 million deduction. That got crimped by Congress. The problem is it's based on being a partnership. These promoters are now doing what's called a tenant in common, or essentially common ownership without it being a partnership, and they're back to doing the deduction. So I think they're going to clamp down on that. What do you think, Roger?
Well, we see there's a tax court opinion about every week involving conservation easements.
Including one this week.
Taxpayers lose just about every one of those. In fact, John Smoltz, former pitcher for the Braves, just lost a big one. I think that was what, $36 million?
Somewhere in there.
Yeah.
So. And they're almost all in Georgia,
Yep.
Tennessee, that area, but mostly Georgia. So, yeah, I think there'll be something coming down the road. Now, for the farmer that wants to do a qualified conservation easement and they have reasons to do it, they're going to be fine. But these promoters out there, they're going to have some
They have
issues.
to have solid appraisals.
Yeah.
And don't get too aggressive. That's what this is. Figure out what your value is before, get a good appraisal on that, figure out what your value of property is after you put the easement on it, take the difference between the two. That's an oversimplification, but that's the general approach. And if you don't push it, yeah, you probably get a deduction. But we see a lot of abuses in that area.
Is that where people usually run into trouble?
Yeah, on the
Yeah.
appraisals.
Yeah.
Yep.
Now, certainly, there are certain states like Maryland where you can get 75% of your fair market value of your property as a payment. And actually, there's some favorable tax treatment on that just reduces your basis. So for a lot of those taxpayers or farmers that bought it in the last couple of years, it's going to be tax-free. Are we running out of time? I feel like the old gong show, the hook is starting to come about my neck here, so.
Yeah, we are running low. I want to give you one last question for each of you. What's the single most important advice you can give to farmers in this for the next year, for 2026? Let's start with you, Harrison.
I would be patient, and I would lean into all of your organizations. I think we're in a time that's probably more difficult than we even realize. I think it's probably got some elements that's chronic, and from agribusiness associations to commodity groups down to the county committees and your farm bureaus, I think farmers, lenders, they're all going to have to lock arms and they have to push real hard. I think the budget deal at the end in December is a microcosm, and ag is, on the one hand, the most regulated industry, but it's also the most mature industry, and that's one thing it's got going for it that can help. That it sometimes doesn't realize about itself. There's places I speak, I'm at the 89th annual fill in the blank, whatever commodity, whatever trade association, 101st this, they got to lean into that so that those numbers keep going up, because it's a real critical time period.
Right. We saw that influence with MAHA and what happened between May and August on that report. Roger?
Well, I'd say one of the good things to keep in mind, and this will dovetail within everything I want to say here, is that we finally got a tax bill signed in July, not in December or in January. So we've got a lead-up time to plan. We know what the rules are going to be going forward. We can plan for that. We can do year-end tax planning. And there's a lot of money, as Paul indicated, that's going to be flowing into agriculture next year. And lenders are already, some I know of that are looking to retool loans to put off the payment until next year because they know that money is coming. The other thing is that farmers should try to remain diversified. When grains are down, livestock usually is high. When livestock high, grains are down. And if it's my financial person doesn't tell me to put all my money in one mutual fund, for example. You want to diversify. Well, it's the same thing in agriculture, but the problem that we've got is their farm programs tend to incentivize monoculture production, particularly the crop insurance side of things. And so you got to battle with that too. But net farm income nationwide is going to be up this year, but that's coming from the cattle side. So if you don't have cattle, that doesn't help you a whole lot. And it's projected to be even higher next year. But watch the trade issue. I like what Harrison said. I've got 2 articles on my Substack talking about the unitary executive and who's in charge of the administrative branch. And then I wrote an article a couple of weeks ago as to, here's why the Supreme Court will reverse the lower court and uphold the tariffs. But that's a huge issue because if they follow along what the lower courts did, there's going to be a lot of economic issues. The bond market will not react favorably to that at all, and that's a totally separate issue. But that's going to have ripple effects if they say the president can't do the executive order trade issues.
Correct.
The problem with being the last person, they've already said everything I was going to say. But I guess the one thing, maybe on my blog, I'll tout the blog. Every month when the WASDE report comes out, I'm going to update the estimates of what PLC and ARC yield payments might look like next October. So for those farmers that are interested, that's one place they can go get that information.
Okay. With that, join me in thanking Paul and Roger and Harrison for their time.